Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we are very privileged to have with us Alan Blinder, Professor of Economics and Public Affairs, Princeton University, US, also former Vice Chairman of the Federal Board of Governors, US Federal Reserve, and member of President Clinton's Council of Economic Advisors, who is joining us now on Skype. Welcome to the show, Professor Blinder. Let me start by asking you, how do you see the global economy? Do you share the IMF's pessimism? Do you see the world heading into another recession?
I'm not so sure we're heading for another recession. The problem is you can never tell until you're already in one. But the global economy certainly looks weaker than it did a year or two ago. And that includes all the major economies, US, China, Japan, Europe, all of them.
But the US economy is doing quite well. It's now into its 10th year of expansion. So is there reason for such pessimism?
10 years, yeah. It is doing well. It'll just slow down a little bit from its recent pace. Not a great deal, but there are, I think, what's the right way to say this? I think the pessimism about the United States is overblown. That said, there are some clouds hanging over the United States, most prominently the trade war, which has decimated agriculture, a tiny sector of the US economy, but has also thrown the manufacturing sector into a recession. Now, you want to remember that manufacturing is only about 10% of US employment. So you can have a manufacturing recession without having a national recession, and that's what we're having right now.
How much of the slowdown is driven by trade wars and decline in global trade, Professor Blinder?
Yeah, a little bit. I think the answer to your question about how much of the world's slowdown is due to trade is a great deal. It is normal, as you no doubt know, in the modern world, for world trade to be growing faster than world GDP, and that stopped. And in some countries like ours, it's growing more slowly than GDP. And I think you can attribute that to trade frictions of various sorts. Is the world moving towards protectionism? I certainly hope not. We're not talking about politics here, but I hope the United States will get rid of Donald Trump soon. And when we get rid of Donald Trump, I think we'll get rid of protectionism.
Do you see the US-China trade wars as bereft of all economic logic, but yet at the same time, they seem to enjoy public support? What explains that?
Free trade has never been terribly popular in the abstract. When you talk more concretely about the benefits of trade, you get a better reaction. But in the abstract, the Americans, and it's not just Americans, many people in many countries are not abstractly attached to free trade the way economists are. Is there a logic to there is a logic to the China-US trade friction, but it's not what President Trump is constantly talking about, which is the bilateral trade deficit. There is no logic there, as we economists always try to explain. There are bilateral deficits and surpluses all over the world. That's normal for trade. The logic, to the extent there is logic, has to do with intellectual property protection. The Chinese are notoriously bad at that. They require giving away trade secrets. They steal trade secrets. They don't abide by patent protections, and the list can go on and on. That's where we should have been focused from the beginning, but it's not where President Trump focused U.S. attention.
But the latest U.S. trade deficit numbers for September show that the trade deficit has narrowed. So is there a risk that it might send the wrong signal that President Trump's policies are actually working?
Yeah, a little bit, I suppose it does. When the U.S. economy slows down, the trade deficit usually slows down. That's true of most countries because you're not importing at the rate that you used to be. It's a pretty small change. The trade deficit, you're talking about the multilateral trade deficit, which is the right thing to look at. It's very large indeed. And the main reasons are domestic, having nothing to do with trade. Americans don't save very much, and the government has just gone in for a tax cut at the end of 2017, which has blown up the budget deficit to levels that we really don't see in peacetime, and there's no reason that we should have a budget deficit. that large. But when you have a budget deficit, that likely contributes to a trade deficit. And some of that's happening now.
Do you see the world turn increasingly protectionist? We see it in the case of Brexit as well.
Well, I sure hope not. This comes back to the question you asked before. I'm sitting here in October, the end of October 2019, hoping that the era of Trump will be short-lived. We do, never minding impeachment, we do have an election in a little over a year, and hopefully we will get a more reasonable, intelligent leadership in the White House. And look, multilateralism relies on the United States. We are the giant economy on the globe. If we're not in the lead, or at least close to the lead, other countries could seize the initiative and suggest things, that's fine. But if America's not going along with multilateralism, and President Trump isn't, it's very hard for multilateralism to succeed. But I hope we'll get back to that. We certainly were there under President Obama and under President Clinton, and even under President Bush. He was a multilateralist.
Of course, Brexit was also a reaction against migration from poorer East European nations, which the UK was not very happy about.
I think it is. I think that's fair, although the circumstances there are very special. That has much less to do with trade, the Brexit, than it does with the perception in the UK by some people, by a narrow majority of the British, that they were surrendering too much of their national sovereignty over to a supranational organization, the EU. You'll notice as they've tied themselves and the EU up in knots, trying to reach an agreement, they're trying to get one that preserves free trade between the EU, or most of free trade between the UK and the EU, even with the UK out of the EU. That's not easy. And it may prove close to impossible. We'll see. But I don't really see that as mostly a revulsion against trade. I think it's mostly a revulsion against what the British see as a wave of regulations and interferences with domestic affairs coming from Brussels.
And do you subscribe to the view that emerging markets are likely to be harder hit in this round of slowdown?
I do. A sad fact of life is when things turn sour in the world. I don't want to exaggerate. Things are not terrible now, but they're not as good as they were a year or two ago. And when things turn sour in the world, the poorer countries suffer more than the richer countries. That's normal. That's what usually happens. It's very unfortunate, but yes, I think there will be a number of poorer countries that suffer more than, say, the United States or the United Kingdom through no fault of their own.
In the choice between fiscal and monetary levers, there is a view that monetary policy has run its course, and now it's the turn of fiscal policy. We've seen talk of modern monetary theory, etc. Do you agree with that assessment? In fact, the ECB's Mario Draghi has made an impassioned plea for more fiscal support. Do you agree with him?
I think it's not so much that it will not help, is that in many places, the EU is prominent, but the United States is another. There isn't that much room to make monetary policy easier than it already is. You've got negative interest rates, for example, all over the, not in every country, but in many countries of the Eurozone. So I wouldn't quite say monetary policy in Europe has done all that it can, but it's getting close. On the other hand, there's room for more fiscal expansion. Getting a little of that in the EU, but they could do more, and I think they need to do more. If you look at the U.S., of course, it's the fiscal picture is the reverse. The Trump administration came in 2017 and immediately embarked on a fiscal expansion that we didn't need at full employment, but we've gotten it anyway. So I think the time for fiscal expansion, the time is ripe for more fiscal expansion in Europe, but not in the United States.
Turning to the specific case of the U.S., has monetary policy in the U.S. reached its full potential, or is there more room?
A little bit. I mean, our interest rates are not, the Fed's policy rate is not zero. It could be lowered. It could go back to quantitative easing if it needs to. It could go back to more rigorous forward guidance to try to talk down interest rates if it needs to. I don't think any of that is necessary yet, although, as you know, the Fed is cutting interest rates very gently and gingerly and warily, but cutting interest rates. So there is more that could be done by the Federal Reserve. It's I guess the right way to put this is it's further, a lot further from its limits, from reaching its limits than the ECB is.
Let me interrupt you there for a moment because it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with Professor Alan Blinder, former Vice Chairman of the US Federal Reserve, on the economic situation in the world, the tussle between President Trump and the Federal Reserve, and what are the choices between monetary and fiscal policy to get us out of what we see a slowdown staring us in the face. Professor Blinder, you've been the Vice Chairman of the US Federal Reserve, so you're familiar with the tensions between elected governments and central banks. We've seen that in India too. So how do you see the present tussle between the Federal Reserve and President Trump?
Yeah, well, I can't speak for India, but you're certainly right what you say about the United States. The President Trump has been more hostile towards the Federal Reserve than any president in a very long time, before Bill Clinton. You know, people often forget and think it was always peaceful between the White House and the Federal Reserve. That's not true. It really started with Bill Clinton in 1993, 94. Before that, the elder President Bush was more or less at war with the Fed, and other presidents had been at war with the Fed. But in those cases, and also at least so far with Trump, it's been basically a war of words, not actions. At least so far, President Trump has not tried to take any action that would undermine the Fed's independence. As you may know, he talked for a while about removing Chairman Powell from office, and I think cooler heads and saner heads around him pointed out that he can't do that, and so you don't hear very much from him about that anymore. He snipes at them, he tweets against them, but he hasn't really done anything effective against the Fed, and I hope he won't.
Post-India adopting inflation targeting, we've had reasonable success, in fact very good success on the inflation front, but that has led to some sacrifice of growth. How do you view the debate between dual versus single mandate for a central bank?
I definitely do, with one big exception. I'll just mention the exception and come back to why I do. The one big exception is if your inflation is way too high and you need to get it down. And that's the key thing. By the way, that's the situation that prevailed in New Zealand when they started this way back around 1990 or so. It's not the situation in the United States. It's not the situation in Europe. It's not the situation in the UK. I don't think it's the situation in India either. The thing about the dual mandate is that it what's the right way to say? It helps match the central bank's words to its deeds. None of these inflation targeting central banks have a monomaniacal focus on inflation. They all care about employment. They all, so to speak, pull their punches, their anti-inflation punches, if unemployment goes high and GDP growth goes negative. So they really are behaving as if they had a dual mandate, even though they say they don't. Now, you could react to that, and some people do, by saying, well, what's the big deal? Let them just say they're inflation targeters, even though they're caring also about employment and GDP growth. The big deal, I don't want to exaggerate this, but I think it's something, is that, first of all, a matter of honesty. As I said, it's a good idea for central banks to match their words and their deeds. And secondly, I think it does have an effect. I think it does go some way, not all the way, but some way to explaining why, for example, when the real serious worldwide recession hit after the financial crisis, the Federal Reserve was much more aggressive in propping up growth in the United States than the ECB was in propping up growth in Europe. And Europe is still paying the price for that.
Professor Blinder, you had a ringside view of the global financial crisis, and your book, When the Music Stopped, was a bestseller of the times. What are the key lessons from the global financial crisis a decade later? And in hindsight, Alan Greenspan's statement that you can't predict the bubble in advance because you don't know when it is a bubble, so it's much easier to pick up the pieces. Would you agree with that assessment?
I half agree with it in the sense that it's not so easy to know when you've got a bubble and when you should uh, when you should prick it. But it's not easy to pick up the pieces. That's been very clear, even in the United States, where we did fairly well, but especially in Europe and a variety of other places. I think it's important to distinguish, as we didn't used to many years ago, between a financial bubble that's built on heavy leverage, a lot of borrowing, and a financial bubble that is not, that's based on equity. So draw a contrast between the bursting of the tech stock bubble around 2000, where the collateral damage was minimal. People that were heavily invested in tech stocks lost everything practically, unless they happen to have picked the right ones like Google and Amazon, which did very, very well later. But most of those tech companies, the dot-coms of 1998, 99, aren't with us anymore. But that was a pure equity bubble, basically, with very little borrowing, very little involvement of the banking system. The housing crash in the United States and the United Kingdom and Australia and Ireland and many other places was built on debt, heavy, heavy borrowing at all levels. Leverage of households, leverage of banks, leverage of shadow banks, lots of synthetic leverage created through derivatives. And when that house of cards crumbled, the mess was tremendous. It was not at all easy to pick up the pieces.
One of the key learnings of the global financial crisis, and one that you have also favored, is greater and tighter oversight of the financial sector. But after some initial moves in that direction, things seem to be going back to where they were before the crisis, especially in the US. Why?
It's two things, and they're related. One is forgetfulness, that as the crisis recedes into the deep recesses of people's memories, they forget about how bad it was, and they forget about some of the things that went into the ingredients that went into building that crisis. But the second more important thing is politics. The financial sector in the United States and in a lot of other countries is quite powerful. They lobby effectively, they make big campaign donations, and they gradually, so the two interact. As the populace and maybe even the Congress starts forgetting about how bad things are, the complaints from the financial institutions about how tight the corset is start resonating politically. And that's what's happening. And they chip away at the regulations and sort of brick by brick, they take apart the wall. Now, having said that, I think we're still in better shape today. We've lost some pieces of the post-crisis reforms, but I think most of them are still standing.
You spoke of quick US action to tackle the global financial crisis, and the TARP, some kind of a bad bank, was one of the key mechanisms that the US adopted. In fact, you had argued that the US government's failure to save Lehman was a tragic missed opportunity, and it was right to rescue even a non-bank like AIG, even though that meant essentially rescuing its creditors. But we in India have hesitated to go down that path, even though we're now in the midst of a financial crisis, because we fear the moral hazard.
It does. It does. Having the fire department come save your home when it's burning up also creates a moral hazard. Moral hazard is a reality, but it's not an absolute. It's not the only consideration. I would point out in those cases that so you mentioned Lehman, where we let it fail, AIG, where we didn't. Bear Stearns was kind of, the company doesn't exist anymore, but it didn't go to bankruptcy court. In those cases, the shareholders lost almost everything. The management lost their jobs. The moral hazard problem that existed, the real moral hazard, so the point of that is nobody wants to emulate those executives. That wasn't such a great deal. for the people that were heading those firms or the shareholders in those firms. The real moral hazard comes from the financial institutions and some individual investors, but mostly financial institutions that lent them money. They got bailed out. Instead of losing money by making bad loans, the government came in and made sure they got, in most cases, 100 cents on the dollar, and that does create a moral hazard. But you have to ask yourself, what would have happened if we didn't? By the time Lehman Brothers went under, faith in financial institutions in America and around the world was at a very, very low ebb. The financial system was imploding. If we had stood on the moral hazard high ground and saying, we have to teach these people that made bad loans a lesson that you suffer losses, the whole thing might have crumbled. The US banking system might have crumbled. The world banking system might have crumbled. And we could have been in a deep, deep depression instead of the worldwide recession. So I think we were right to sort of shunt moral hazard concerns aside. They're not negligible, they're there, they're real, but we shouldn't let them rule the roost, especially when you're in a crisis. That's like telling the fire brigade not to put out the fire because we need to teach a lesson to the careless homeowner. It's not a good idea. It's not what fire brigades do.
But doesn't that set a bad precedent?
You know, I have a hard time with that question because it depends on what the alternative was. I think compared to allowing the whole financial system to collapse, it set a good precedent.
What is it about the housing sector that so many financial sector crises are invariably linked to problems in the housing sector?
I think there are two places where you see large gambling, a lot of financial gambling, which are different in character. One is the stock market around the world. So if you ask yourself, where do financial crises generally start? There are only two places: stock markets, and there, if there's a lot of leverage a lot of borrowing behind the equity bubble, if there's an equity bubble, you can have a really big problem on your hands. We had that in 1929-30 in the United States. We didn't have it in 2000 because there wasn't a lot of borrowing behind it. The other place where you see huge amounts of borrowing and speculation in case of bubbles is real estate. And this has happened time and time again in many, many countries. It's a place where you can do that. Think about it. It's normal, even in a non-bubble scenario, to have 5 or 10 times leverage when you buy a house. The old-fashioned mortgages in the United States used to be 20% down. That became obsolete during the crisis, and nobody was putting 20% down. But even if you think of a 20% down payment mortgage, it means you'll leverage 5 to 1. If it's only 10% down, you leverage 10 to 1. So there's a lot of inherent leverage in there. And then if you layer on top of that the kind of craziness that Bob Shiller and others talked about, the false belief that you can never lose money in houses because they always go up in value. It's not true historically, but somehow people believe it from time to time and country to country. Put those two together and you have the potential for a big speculative fever. And we've seen it any number of times.
Do you see crises as inevitable in the modern banking and capitalist system? Because every few years we see a financial or a banking crisis somewhere in the world, Professor Blinder.
I don't think it's modern. Let me take you back to almost the first joint stock company, the South Sea Company in Britain, which was it was one of the first equities ever issued, not the very first, but among the very first. And it was the first financial bubble. We've had financial bubbles since we've had finance. And before we had finance, we had tulip bubbles. So I think it's in the nature of humans to speculate, to get visions in their head of fabulous wealth, and to take chances that in retrospect look foolish, but in prospect aren't so obviously foolish. So yeah, I think we'll always have them. What you want to do is build some sturdy infrastructure so the whole system doesn't collapse when a relatively small people go crazy and have a financial bubble. Again, I'll point to the tech stock bubble which burst in 2000 as an example. Because there wasn't any leverage to speak of, very little leverage, very little involvement of the banking system, the collateral damage was minimal from that. So we'll have things like that again. I mean, look, we may have it now. I mean, there are a number of tech stocks in the United States that have pretty high valuations. Who knows? In a couple of years, we may look back at the year 2019 and say we were having a tech stock bubble then. But it's not based on leverage. It's based on equity.
So how should we guard against the next crisis? Or is it not possible at all?
I think you want to supervise carefully the banks and the stock brokerages, which was not done in the years 2005, 6, 7. You want to be very cognizant, and I think we have mechanisms that are now, of buildups of leverage that can collapse when things go wrong, and have the kind of have contingency plans for the fire brigade, so to speak. You may remember, I'm sure you do remember, that after the fact, both then Secretary of the Treasury Paulson and then Fed Chairman Bernanke bemoaned the fact that when Lehman Brothers hit them in the face, they didn't really have the tools they needed to resolve it in a sensible way. Hopefully we have those tools now.
So what are these tools that you have in mind?
Those tools, well, they start with better supervision, but if you get a collapse anyway, you want something in between the bailout scenario, like Bear Stearns, and the bankruptcy scenario, like Lehman Brothers. So we now have a mechanism in law, it's not been tested yet in the United States, that kind of would put a company like Lehman Brothers to bed quietly and peacefully, like the FDIC does when a bank goes or threatens to go bankrupt. Do it slowly and gradually with some government funding as interim funding until you can sell the assets, rather than send the thing to bankruptcy court and say to the courts, you figure it out.